The Asian markets getting crushed, having their longest losing streak in over a decade. Let's get to Bob Pisani at the New York Stock Exchange for the details. Hey, Bob.
Hello, Melissa. Is the long emerging market sell-off finally getting close to ending? CNBC has confirmed the United States is in the early stages of proposing a new round of trade talks with China in the near future. Now, that's helped sentiment, but it's been a nightmare for overseas investors in the last few months, particularly in Asia. So what do we have? We've got a rising dollar. We have trade and tariff wars. Then throw in a few countries like Turkey that have high government and corporate debt levels, much of it denominated in dollars. Ouch. And you have a perfect storm for a bear market in emerging market equities. And in fact, with China's Shanghai market 30% off its 52-week highs, it hit just in January. Hong Kong's 26% off the 52-week highs. Turkey's 24%. Philippines closed, they're down 17%. Indonesia and Korea are also off their highs by double digits. Now, the benchmark MSCI Asia Pacific Index, which, by the way, excludes Japan, fell for a 10th straight day. All right, it's ugly, but it's not unprecedented. You know, after the financial crisis, emerging markets generally outperformed the U.S. market for a number of years, but that began to change about 2014, late 2015. That was another bad year. That was when the China boom lost some of its luster. China went up big and then down. Still, the performance gap is very unusually wide. Look at these numbers. Asia is certainly cheaper and oversold, and all other things being equal, we may be near a bottom, but that's the problem, all other things being equal. Whether it's worth buying Asia and emerging markets on a mean reversion trade depends on your view of other things, like the dollar, and on trade, and particularly the later performance of the U.S. markets later this year. So if the U.S. stock market sees any notable drop in the next few months, that will certainly create a risk-off environment in other markets. In all these emerging market stocks, they could fall even more. Look at the outperformance here of the U.S. markets versus those emerging markets. So this is a tough call about whether this is the right time to buy them. Back to you, Melissa.
All right, Bob, thanks. Bob Pisani at the New York Stock Exchange. Chartmaster has made his way over to the plasma. He says there's even more pain ahead for Asia. Carter, what are you seeing?
It looks that way. I first wanted to just talk about the whole concept of why 20% is not a bear market. This is the Shanghai Composite over the past, well, you can see here, 2003 to 2018. So think if we applied that rule. I mean, that would then imply or be said that we had a bear market here in 2004, and then we had another one in 2009, and then we had another one in 2011, and we had another one, and then we had another one. That's patently ridiculous, yes? In fact, if we go to the next screen, it means that these were all bull markets when it went up 500%, and then it went up 100%, and then 40, and then it was another. There have been one bull, one bear, and we've had a second bull and bear. Let's look at it. What we know is this, that this was essentially a bull market all through here to the peak, the commodity peak, that this was a bear market, that this was a second bull, and that we are now in a second bear. The 20% thing, nonsensical, stay away from it. More importantly, how much worse could this get? If you just draw a simple trend line, my hunch is that we come down and we find this line. We've been here a few times. It implies another 6 to 8%. Could happen overnight. This is a highly volatile kind of thing. But emerging markets in general, and Shanghai specifically, not good.
Should we invite Carter back over to the desk?
Yes.
Just kidding. Carter, come on back. Tim, what do you say?
Well, I think both Bob and Carter hit on some very important things. If the U.S. has been flailing, or I should say, let's put it this way, the U.S. has been outperforming, and at some point, if the U.S. gives back ground, it's not going to help China and emerging markets. You know, they're going to sell off even more. They will underperform on the downside, I think, actually, relative to what they've done. The bottom line here is I think that the fundamentals don't really reflect where I think the markets have moved. And you've underperformed. It's underperformed EM to the S&P by 20% since April. I mean, this is an extraordinary time. I am an EM long-time investor. I am not running back into emerging markets here because, first of all, I don't know the outcome of this trade war. And because this is not your classic trade war, and they're probably all different, but this to me is really about China 2025. And I think we're going to be digging in our heels for a long time.
I don't know the protocol here. Am I allowed to ask Carter a question since we brought him back? Sometimes that's taboo. So I am.
We didn't goodbye the guest. I mean,
I don't know, Tim. That's why I said I don't know the protocol. It's different tonight.
Anyway, what's your question?
My question is this. Are you surprised? What needs to give? Does the S&P need to give to the downside? Are you surprised we haven't seen a bigger sell-off, any sell-off for that matter, in the S&P?
That's the great question, right? When you have bifurcation, not only do we have it globally, most aggregates have rolled over while the U.S. continues higher. We have it internal to the U.S., right? Financials have rolled, a lot of industrials have rolled, and certain parts of the market. Bifurcation almost always is resolved by the weak having a final capitulatory low, that would be a sort of a dump in EM, and the strong one succumbing. And we're seeing a little bit of that in Apple, a little bit of that in Amazon. So this is a normal conclusion, and it should, in principle, be the same thing with U.S. relative to global.
Yeah, but what I think is really fascinating from an economic perspective is that no one is sitting here thinking that this could be like kind of like the canary in the coal mine, that every major equity index outside of the U.S. is down on the year, and specifically the ones that we're talking about that have much higher growth at a time where we are so focused on printing 2 consecutive 4% GDP quarters, when a lot of economists see dramatic slowdown in the back half of the year or the start of 2019 in the U.S. So what if all this equity weakness, what if all this debt weakness, what about the dollar that stayed firm? It's not rallying right now, and some are calling it for it to go lower. What if it really means that we're going to see a global slowdown? A big part of the bull market in 15 and 16 was about this global synchronized recovery. Well, we recovered. So maybe now we're coming back in globally, and maybe these equity markets all around the world are telling us that, and we're just not paying attention.
A lot of those equity markets are actually up in local terms, not in dollar terms. So, I mean, they're not all going straight downhill, but I agree with you. I'm watching the PMIs. You have -50, so contracting PMIs in Hong Kong and other parts of Asia.